Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. Here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. I'll start with Paris milling wheat. I've tried to look at both charts here, daily and monthly, as I'd recently only used the monthly chart, all to get better definition. Well, whilst I speak a little about the daily chart, in my mind, it still just doesn't cut it. So, looking at a daily chart, after the peak of the market, we've had the changeover gap, 326 3/4 to 365 even. That opened below the 2022 50% Fibonacci line at 341 1/4. The market looked like it was trying to fill in the gap, but failing and falling short at the 50% Fibonacci line. However, if you look closely, most, bar perhaps last Friday and yesterday's action, were actually indecisive spinning tops, daily indecisive spinning tops. This, it seems to be the market being unsure about filling in the gap, as well as testing down to the significant Fibonacci congestion below in the 308 to 308 1/4 area, as well as the November 2021 high at 311 1/2. Now, there is an uptrend I've drawn here since February, currently at 319 1/2, but I readily am expecting to have that reassigned. Hence, the market is still not giving away any significant patterns or actions on the daily chart. Meanwhile, on the monthly chart, well, there's a lot more action and detail. We'll start with how the market got here. For this, you'll have to look back at the 2010 to date uptrend, currently at 176 1/2, and the broken but hugely important 2007 to date downtrend, currently at 242 3/4. These two together formed a huge 2007 to 2021 sideways triangle. This had an initial target X in the 360 1/2 area, which is coincidental with the mid-2021 to date bullish halfway hesitation target, and then two secondary targets, depending from whence you measure, of target X2 in the 423 area and target X1 in the 405 area. I could also describe the targets for the 2012 to 2021 rounded bottom, but they are so far below the market as to be superfluous. So what happens now? Well, prices have pulled back from their excessive highs. Below the 50% Fibonacci line for 2022 at 341 1/4, which is now resistance, but prices are now starting to hit some combined Fibonacci supports in the 319 1/2 to 321 3/4 area. Yet the next important level on the downside will likely be the 2007 high at 300 even. Then after that, the 50% Fibonacci line of the 2016 to date move at 287 1/4. Mind you, I have a suspicion at the moment that the 2022 lows at 259 1/4 and 258 1/2, well, they're key to any part of this market maintaining the current bullish incentive. This brings me to my final point. We are far, far away from completing this month, but where we are right now, well, that leaves the month of March looking like a huge indecisive spinning top right at the top of the market. If that is to be the case, then it may not be surprising to see April showing a significant bearish pattern. Right now, what is needed to maintain a bullish incentive is a move up over the 50% Fibonacci line at 341 1/4. Failure to do so, and also to hold on to the nearby uptrend at 329 3/4, may see prices drop back within the huge sideways triangle, and also test the early 2021 highs between 232 3/4 and 236 even. London, UK feed wheat. Okay, so I've really tried looking at the daily chart here, but it really doesn't help at the moment in interpreting the market. Hence, once again, I find it easier to use the monthly chart here compared to the daily chart in my weekly commentary. So what can I see? Well, this market is different by a long way from the US wheat markets and even Paris milling wheat. There are three key patterns to consider here. One is completed, one is under attack, and one is in operation. The most immediate and the one that has been completed is the 2019 to date bullish halfway hesitation. This had a conservative target X in the 245.5 area and a more liberal target X1 in the 264 even area. The difference between the two was that the conservative target fully utilized the July 2021 low at 164 even as a measuring point, whereas the more liberal target utilized the optimized lows last year in the 181.5 area as a measuring point. Both were easily achieved. Target X was reached last month and target X1 this month for strong gapping move higher, oddly enough. The next key pattern is the 2016 to 2019 bullish Andrews pitchfork. Now, since 2019, this market has done a reasonable job of utilizing this pitchfork as the bullish angle of attack. Admittedly, there was a breach of the lower time, currently at 182.20, but it was a monthly bull hammer pattern back in July 2021, and there were no closes below it. Meanwhile, the middle time, currently at 227.80, has done a pretty good job, initially as a rolling higher resistance, and more recently as a hesitation area. So what is now going on here? Well, this pattern is under attack as prices have this month gapped higher and pushed up through the upper time, currently 273 even, by some considerable distance. If prices close over the upper time at the end of this month, then this pattern would be breached. Then having two or more consecutive monthly closes over the upper time would terminally break this pattern. So this is one to watch. Finally, we may have another new pattern developing here. It is to regard the whole 2005/2007 today action as a possible huge expanding wedge pattern. The upper trend line, currently at 297 even, and the lower trend line, currently 219.70, look viable, though one could look at the 2008 today uptrend, currently at 108.40, as a shallower alternative to the older uptrend. That is what the state of the market looks like right now. I would be most interested to see how this month closes out. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investors International Limited. And here comes the final bit.